All right, just a quick review of the markets. All right. So today, right off the open, there was a significant amount of selling pressure. So you see the S&P, basically the volume came in right there, trend shift right there, takes out multiple lows right off the open, and immediately you saw, from that gap selling straight down. The gap up to selling straight down. Gap up to selling straight down. Gap up to selling straight down. Basically, they just sold the bounce or sold the rally or sold the open or whatever. They just sold. And then the market continued to go down. So very clear selling pressure. And that's all you really needed to see. And then here, it was just here, right here, there was more selling pressure. And I knew it was going to test. That's what it's going to do, right? So all of this was nothing more than this. I think there's some short covering here. I'm not really sure, but it's a little bit early for short covering. Or at least, the morning move, covering the morning move. And all that did was it set up the test and then gave another leg down. How'd you know was because right here you had a pretty strong selling bar, so it was very likely going to go right into that area reject. All right, now the next thing I want to talk about. So, oh, by the way, when it tests, how do you know the pressure is back on? You know the pressure is back on because the pressure is back on right there. So as it went down, it went up, tested right here, the volume started expanding. The selling pressure started expanding. So this was the hint that yes, we're going to go lower. All right, down, up, down some more with more pressure here. So, that's supply. If you're at a level and pressure's coming in and it tries to bounce, can't, and more pressure's coming in, it's going to break. And that's what the market did. So, whatever, that's just the point that I want to make. All right. Now, there's something else that I wanted to touch upon. It's really important in that this is what you'll waste years on. So, when you're looking at price volume behavior, that in itself, by itself, is an error. In that, the idea is, okay, you need screen time and all that, right? Screen time, blah, blah, blah. But here's the facts. The fact is that you have important levels. Okay, now how the market goes from the low to the high or the high to the low is there's going to be trend. Obviously, if it's going from the bottom up, there's going to be a trend, but it's never, whoever did this really oversimplified. Okay, so it's never like that. All right, there's a lot of lower lows, lower highs, and quote unquote patterns, and there's a lot of false signals and all of that. So it's never like, okay, from this support, let's call this support, let's call this resistance, and spread it out, right? It's going to go, but it's never like this. If it was, everybody'd be rich, right? And you'd know exactly what to do and how to do it, but it's almost never like this. It's almost never that clean, because all this means that you just buy the pullback at like 50% pullback and you're good to go. But that's just not the case. Okay, so what happens is the mistake that's made is, first of all, you're focusing on price volume action. All of this is price volume action, right? So price volume action. So looking at the market intraday, focusing on its price volume action and spending time on it is a major mistake. I know some might say, yeah, I need screen time and all this and that, but the truth is that you're missing the forest for the trees, in that what's more important is not the price action, but the important levels, or at least as equivalently as important is the levels, important levels, and seeing their reaction at those levels. A lot of what's between the levels is what is noise. Okay, and the way the market goes from levels to levels, right? This is described as the random walk, or basically noise. All right, this how the market goes from one level to another level. The movement of stocks and the movement of indices is, this is what a random walk is referring to. Meaning, just like the way a drunk person walks, it cannot be characterized. The same way with stocks, how exactly they get from point to point, it's like never the same. It's never the same. And yes, there are patterns there, but there's also a lot of noise. And I'll explain what I mean by that. So let's talk about, let's say you're looking for a change of behavior from, right? So the market, what it does is goes do, 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 and then it does this. If you're only looking at price volume behavior by itself, this would be a sign of weakness. It's a big wave, bigger than multiple waves, takes out the low, has high selling pressure, but there are many, many times when this wave is not the same as a sign of weakness. It's just a selling wave. And what will happen is this will go up, this will test, and it'll continue. Okay? So until there is a sign of weakness. Okay? So the question here is, how do you distinguish a sign of weakness? And by a sign of weakness, I mean the key behavior that causes a downtrend. The impulse, the starting impulse that causes a downtrend, or in a sign of strength, the starting impulse that causes the uptrend. Okay, so how do you distinguish a sign of weakness versus just a selling wave? All right, this is very important for white coat traders, because this is what people don't really get into. But you know, the trend over here was making a high, making a higher high, finally made another higher high, right? And then it made this lower low, and it was a big lower low with the biggest volume and price action and whatever, 8, 4, 5, 6, 7 waves, etc. And when it did that, you want to know whether this selling is a selling wave, or is it a sign of weakness? The reason is, if it is a sign of weakness forecasts the emergence of a downtrend. Whereas a selling wave does what? It gets bought. And then it can either go sideways or it can continue the uptrend. But the reason you want to know if it's a sign of weakness is because a sign of weakness will initiate the downtrend. And that's what you want to get. That's what you want to get and capitalize on a directional trader. So to be able to distinguish a sign of weakness from what was nothing more than a selling wave. A selling wave does not mean that the trend has broken and will now turn downwards. A sign of weak is a selling wave with the additional characteristics of creating a downtrend. Totally different. Sign of weakness creates a downtrend. Selling waves don't. Selling waves have price volume action, but they don't create downtrends. Sign of weakness does. Okay, so that's really important. All right, and that's what you're looking for, that change of whatever, change of character, change of behavior, sign of weakness. So many so many terms, whatever you want to call it, supply. This right here has caused a downtrend. So as a Wyckoff trader, when you're analyzing trends, you need to be able to distinguish a selling wave from a sign of weakness, this type of sign of weakness that can change the trend from uptrend to downtrend. So the way this is done is not just by looking at the time frame and looking at its price volume characteristics. Because if you do that, you will get caught up in what I explained earlier as noise. And in this case, the noise is just selling. It's just some profit taking. It can just be someone selling or whatever, for whatever reason. So you're going to be caught up in the noise. Now, the way I'm describing noise here is that it's part of the quote-unquote random walk. And the key word here is random. So in order to distinguish a sign of weakness from the random walk or randomness or the random noise of selling, you need to see things that are not random. What's not random? And that will help you determine if it is a sign of weakness or not. So you need to eliminate the randomness by filtering, by adding certain criteria which will help you determine with a higher level of accuracy that this is a sign of weakness and it's not just random noise or just some selling or preliminary selling or all that, whatever you're talking about, right? So what are the key things that you're filtering? First of all, let me just tell you this. Looking at a level is not enough. Yes, price went to a level. Yes, it quote-unquote rejected. Yes, there was selling from that level. Does that mean that it's a sign of weakness? It does not. Okay? Just because there's a level, it is not enough. Because trends, to turn them is not easy. And just because the price goes to a level, you could just have a pullback. It doesn't mean the trend has changed. So, but it is one criteria, one filtering criteria. The second thing you need is breadth. When this trend, when this selling pressure comes in, not only this stock, but its peers are also selling off. So you're not looking for just one stock and saying, oh yeah, they're selling, this is a sign of weakness. What you need to do is separate the signal from the noise, and the criteria, yes, includes a level, but it also includes market breadth. And market breadth means that you have other stocks also selling off. It's not just the one stock you're looking at, it is other stocks as well. So basically your peers, the big stocks. So you're looking for market breadth, which means this is just a fancy way of saying other stocks are also doing the same thing. Yeah, my stock A is going down and there's selling pressure, and you know it's not random when stock B, C, D, and E are also going down. This is removing the randomness from just one stock selling off because there is more and more evidence, as shown by stock B, C, D, and E also selling off. That reduces the chances that the selling that you're seeing in the stock that you're looking at is just noise, because it's being confirmed by selling in other stocks. And obviously, an extension of this is if other stocks are selling off, so will the index. So now, when you're looking for a sign of weakness or a sign of strength, you're looking for obviously a higher time frame level, right? But everybody is going to be doing that. Some folks don't even look at levels, they'll just look at the price volume behavior on the chart, and that is a mistake. All right, second, so you want to have a level, but at the same time, it's not enough. I've seen plenty of times where it goes to a level, there's some selling, and basically it just gets bought up and continues. A level is not enough. To help eliminate the randomness and noise, you need other stocks to also sell off, and you need the index as a whole to also sell off, meaning it's market breadth on your side. When you have market breadth, you are now not looking at noise. You have confirmation. Okay, so that's what I'm trying to get across. Many Wyckoff traders suffer from this issue where they are looking at support, looking at resistance, and or not even looking at it, and then market just gives them price volume behavior. So what Wyckoff, the mistake here is if you're just looking at price volume behavior on one time frame and wasting your day, just looking at price volume behavior, that is a waste. You must, because as markets travel from one level to another level or advance or decline, when they do that, there is too much noise. Okay, and it can come from short end of day short covering, or it hits a level, there's some pressure there, or hits a support level, there's some buyers there, or whatever, before lunch or whatever. So there's a lot of noise, and you cannot distinguish and characterize the selling as a sign of weakness. It can be bought. So in order to identify the sign of weakness or sign of strength, you must have market breadth. A level is not enough. You need market breadth, confirmation from other stocks as well as indexes. The chances now that it is going to go down, it has increased. All right, because the probability that the selling you're seeing is noise has greatly diminished, because stock B has selling, stock C has selling, stock D has selling, then the indexes are showing selling. So how could this be noise? Right? That's the point I want to get across. Hope you understand it. Thank you and have a wonderful day. Bye.